It is Thursday, and silver is still holding its ground near the $75 level, but the real tension in the market begins tomorrow morning at exactly 8:30 Eastern Time. Across the financial world, traders, institutions, and investors are holding their breath as the January non-farm payroll jobs report approaches. For the silver market, the importance of this single data release cannot be overstated. Today is January 8th, 2026, and global markets are positioned delicately on a knife's edge. We are currently moving through a technical phase known as index rebalancing, a process that often causes temporary distortions in asset prices across nearly every market. This Thursday represents a critical transition point where large institutional funds and pension managers adjust portfolio allocations to match new year mandates. As a result, silver has experienced choppy price action and uneven volatility, a classic signal that large amounts of capital are being rotated quietly behind the scenes. While silver remains near $75 per ounce, the selling pressure visible today has very little to do with the metal's true underlying value. Market participants understand that this technical pressure is temporary and deceptive. It is the quiet tension before a major release that can redefine price direction in minutes. Tomorrow, Friday, January 9th, 2026, the United States Bureau of Labor Statistics will release the most influential economic report of the month. Known as the non-farm payroll report, this data has the power to either launch silver sharply higher or drive it lower toward major support zones. Trading desks in New York and London appear subdued today. But beneath the surface, automated systems are fully prepared to respond instantly once the numbers hit. For silver investors, understanding what is unfolding today is essential for navigating what may happen tomorrow. Index rebalancing often hides the true sentiment of the market, which is currently focused on signals for Federal Reserve policy. The Federal Reserve requires economic justification for any policy change, and the non-farm payroll report is the most critical data point on their radar this month. Silver's ability to defend the $75 level despite persistent selling pressure is notable. However, there is a clear risk that a surprise in tomorrow West data could cause that support to break, opening the door toward the $72 region. Today's market narrative is dominated by caution, as few traders want to be exposed incorrectly when the report is released. Silver is not only an industrial commodity but also a monetary metal, meaning it reacts sharply to changes in interest rate expectations. Tomorrow, its importance lies in the Federal Reserve, its ongoing search for justification to reduce interest rates. Current market pricing reflects an extremely small probability of a rate cut, roughly 4 basis points, which is effectively insignificant. If the jobs data arrives weaker than expected, markets would be forced to price in a more aggressive cut, providing powerful upside momentum for silver. On the other hand, stronger data would reinforce Federal Reserve hesitation and support a stronger United States dollar. This creates a binary setup where silver could experience sharp movement in either direction within moments of the release. As Thursday afternoon unfolds, traders are dissecting every detail of consensus estimates in search of an edge. Expectations center around a moderate result, often described as a balanced outcome. Yet history shows that non-farm payroll data rarely aligns perfectly with forecasts, and surprises occur far more often than accuracy. Late in 2025, silver surged over 3% in a single session following a weak employment report. That event remains fresh in traders' memories as positioning intensifies ahead of tomorrow. The fear of missing a breakout above $80 is clashing with concern over a decline towards 72 amid rebalancing pressure. Trading volume today is somewhat muted as major players wait for confirmation, creating a low liquidity environment that can exaggerate price swings. Technical charts reveal a tightening price structure, a pattern that frequently precedes explosive volatility once a catalyst appears. That catalyst is the number of jobs added to the United States economy in December 2025. Every movement in silver today reflects anxiety surrounding the health of the American labor market. With the clock ticking toward tomorrow morning, the stage is set for a decisive shift that could reshape the metals market by midday. To understand why tomorrow carries such weight, it is necessary to examine the expectations and mechanisms that link employment data to silver pricing. Consensus estimates suggest job growth between 45,000 and 55,000 positions for December. This range is historically weak and signals a notable slowdown from previous years. The unemployment rate is also under scrutiny, with expectations pointing toward a modest decline to 4.5% following November's elevated reading that unsettled investors. Silver's response to these figures is tied closely to interest rates and bond yields. As a non-yielding asset, silver becomes more attractive when yields decline. Lower yields reduce the opportunity cost of holding precious metals, making them more competitive against cash and bonds. Tomorrow's jobs figure will be instantly translated into interest rate expectations, directly influencing silver's direction. Major financial institutions have highlighted a growing contradiction in the 2026 economy. While overall economic growth remains steady near 2.6%, labor market momentum has stalled. Factors such as government workforce reductions and efficiency gains, driven by artificial intelligence, have limited job creation. This creates an environment where growth exists, but employment lags behind, a scenario that favors accommodative monetary policy. For silver investors, this imbalance is constructive. A stagnant labor market pressures the Federal Reserve toward easier policy, while steady growth sustains industrial demand for silver in electronics and renewable energy. This rare combination creates a supportive backdrop for higher prices. However, the market remains conflicted, as only a minimal rate cut is currently priced in. A weaker than expected report could rapidly change that outlook, potentially forcing markets to price in a full quarter-point cut. That shift would weaken the dollar and support higher silver prices globally. Conversely, a strong surprise would undermine the stagnation narrative and reinforce higher rates, placing downward pressure on silver. Algorithms will react immediately to deviations from expectations, amplifying volatility. Tomorrow's outcome will not be decided by emotion, but by numbers, revisions, and participation data. Negative revisions to prior months would further confirm labor weakness, even if the headline number meets expectations. The labor participation rate will also shape interpretation, distinguishing real strength from statistical illusion. This ongoing struggle between economic growth and labor softness will be resolved at 8:30 tomorrow morning, and silver will respond accordingly. As the countdown continues toward the release, it becomes essential to break down how each component of the report interacts with silver pricing mechanics. The market is not reacting blindly to a single headline number. Instead, it processes a layered set of inputs that together determine expectations for monetary policy. The consensus forecast, calling for 45,000 to 55,000 new jobs, already reflects widespread concern that the labor engine is losing momentum. By historical standards, this level of job creation signals an economy that is no longer accelerating, but instead coasting carefully. Alongside the payroll number, traders are equally focused on the unemployment rate, which is projected to ease slightly to 4.5%. While a lower unemployment rate typically sounds positive, context matters deeply. If that decline results from discouraged workers exiting the labor force rather than genuine hiring strength, markets interpret it as weakness rather than improvement. Silver pricing reflects this nuance because it is sensitive to both economic confidence and monetary response. The relationship between employment data and silver can be explained through the behavior of yields. Silver does not generate income, so its appeal rises when yields fall. When interest rates are elevated, investors gravitate toward bonds and cash instruments that offer predictable returns. But when yields decline, or are expected to decline, the disadvantage of holding silver diminishes rapidly. This is why employment data functions as a trigger rather than a standalone signal. Tomorrow's jobs number will immediately be translated into probabilities for Federal Reserve action. Even small deviations from expectations can produce outsized market reactions. Analysts at major banks have highlighted the unusual structure of the 2026 economy, where headline growth remains respectable while job creation stagnates. Economic output is expanding, but efficiency gains driven by automation and artificial intelligence are limiting employment growth across multiple sectors. This disconnect creates a policy dilemma. Growth near 2.6% supports continued industrial demand for silver, particularly in technology, electronics, and solar manufacturing. At the same time, a weak labor market forces policymakers to consider easing financial conditions to prevent a broader slowdown. This dual dynamic forms a powerful foundation for silver, which benefits from both industrial consumption and accommodative monetary policy. Despite this supportive backdrop, the bond market is currently pricing in almost no chance of an immediate rate cut. The 4 basis points reflected in futures markets amount to little more than noise. A weak employment report would challenge that pricing instantly, forcing traders to adjust expectations toward a full quarter-point reduction. That repricing would pressure the dollar lower and lift silver as a dollar-denominated asset. Currency dynamics play a central role in silver valuation. When the dollar weakens, silver prices tend to rise simply to maintain purchasing power across global markets. This relationship operates mechanically rather than emotionally. A weaker currency increases the nominal price of commodities, even if real demand remains unchanged. However, the risk scenario remains present. A strong surprise, particularly a payroll figure exceeding 100,000 jobs, would disrupt the prevailing narrative entirely. Such a result would suggest that labor stagnation concerns are overstated. Bond yields would likely spike as traders abandon expectations for near-term easing. The dollar would strengthen, and silver would face immediate selling pressure. Automated trading systems dominate the initial reaction to the report. These algorithms are programmed to respond to deviation from consensus, not long-term fundamentals. The neutral zone between 45,000 and 55,000 jobs represents an area where volatility may remain contained. Any reading outside that range is likely to trigger a cascade of orders that overwhelms liquidity. Revisions to prior months will also influence market interpretation. Downward revisions reinforce the idea that employment weakness is persistent rather than temporary. Even if December meets expectations, negative adjustments to previous data would strengthen the case for policy easing. Silver tends to respond favorably to such confirmation, as it supports lower yield expectations. Labor force participation adds another layer of complexity. A declining unemployment rate driven by workforce contraction rather than hiring strength signals economic fragility. Markets distinguish between healthy employment gains and statistical improvements that mask weakness. Silver reflects this distinction because it responds not just to growth, but to confidence in monetary stability. At its core, tomorrow's release represents a struggle between industrial resilience and labor softness. Growth supports demand, while employment weakness supports policy accommodation. Silver thrives when these forces align. The challenge lies in the short-term volatility created by headline surprises and algorithmic trading. As the release approaches, positioning becomes increasingly cautious. Many institutional participants prefer to wait for confirmation before committing capital. This hesitation reduces liquidity and amplifies price swings once trading resumes in force. The tightening price structure visible today reflects this tension. Every tick in silver pricing ahead of the report represents collective uncertainty. Traders are not betting on direction as much as they are managing risk. The knowledge that markets could look entirely different within minutes keeps participation restrained. When the number is released, the initial move may not reflect the final trend. Knee-jerk reactions often reverse as deeper analysis emerges. Banks and large funds frequently use early volatility to establish positions at favorable levels. This behavior can create false breakouts or breakdowns before the true direction asserts itself. Understanding this dynamic is critical for investors watching key levels. The $75 zone remains pivotal today, but it may be tested aggressively once data hits. Support near $72 represents a critical threshold that could determine whether selling accelerates or stabilizes. Conversely, upside momentum toward $80 depends on a meaningful shift in rate expectations. The market requires evidence strong enough to justify repricing policy risk. Without that, rallies may struggle to sustain themselves. Tomorrow's data will not just influence silver for a day or a week, it will shape expectations for the first quarter of 2026. Employment trends will guide policy decisions, currency movement, and risk appetite across markets. As the final hours tick down, the market prepares not for certainty but for reaction. Silver stands at the center of this moment, poised to respond instantly to the direction set by labor data. The outcome will reveal whether caution gives way to conviction or volatility reigns unchecked. As the final hours before the release approach, investors must prepare mentally for the specific paths silver could take once the data is revealed. There are three primary outcomes the market is bracing for, and each carries a very different implication for price behavior. Preparation is not about prediction, but about understanding probability and reaction. When the clock strikes 8:30 tomorrow morning, hesitation will be costly. The first scenario is the bullish outcome, where job creation comes in below 30,000. A print this week would immediately raise fears that the economy is sliding toward recession territory. In that environment, traders would rapidly increase bets on aggressive Federal Reserve intervention. Bond yields would likely fall sharply as capital rushes into safety, and the United States dollar would weaken in response. For silver, this is the ideal setup. As a monetary metal, silver benefits from declining yields and rising uncertainty. A sub-30,000 result could propel silver rapidly toward the $80 level, as traders scramble to reprice risk. Silver has historically performed well during moments of economic stress because it serves as both an industrial input and a store of value. A weak labor report undermines confidence in growth durability, increasing demand for assets perceived as protection. In this scenario, any selling pressure created by index rebalancing would be overwhelmed by fresh buying interest. Momentum traders would join quickly, reinforcing the move. The second scenario is the bearish surprise, where job growth exceeds 100,000. This outcome would shock markets, as it would directly contradict expectations of a cooling labor market. Bond traders would reassess the likelihood of near-term easing, pushing yields higher. The Federal Reserve would be seen as justified in maintaining restrictive policy longer. A stronger dollar would follow, applying downward pressure on silver prices. In this case, the selling already present from index rebalancing could intensify. Silver could slide toward the $72 region, an area that represents critical technical support. A break below that zone could trigger additional stop-loss orders, compounding the move. Bulls would be forced into defense mode, and confidence could be shaken in the short term. The third outcome is the neutral scenario, where job growth lands between 45,000 and 60,000. This result would largely confirm what markets have already priced in. Initial volatility may still occur, but direction would likely remain uncertain. Silver could continue to oscillate within its recent range as traders wait for the next catalyst. Even in a neutral outcome, the broader trend remains supportive. The underlying issue of labor stagnation has not disappeared. Structural changes driven by efficiency and automation continue to limit job growth potential. As long as that remains true, pressure on policymakers to ease conditions persists. It is also important to consider how large institutions behave around major data releases. Initial reactions are often exaggerated as liquidity thins. Big banks frequently use early volatility to accumulate positions quietly. A sharp move lower immediately after the release does not necessarily signal long-term direction. Investors must distinguish between reaction and resolution. This is why patience is critical in the minutes following the release. Silver's true trend often emerges after the initial surge of algorithmic trading subsides. Human decision-making returns to the market as traders evaluate revisions, participation rates, and wage data. These secondary details can alter interpretation significantly. The ultimate objective for silver bulls is a sustained break above $80, followed by consolidation that establishes new support. Achieving that requires a meaningful shift in rate expectations. The market must believe that easing is not optional, but inevitable. The 4 basis points currently priced in are insufficient to drive a lasting rally. Tomorrow's report has the potential to change that calculus entirely. If markets begin to price in a full quarter-point cut, silver's upside expands dramatically. Conversely, if easing expectations collapse, consolidation or retracement becomes more likely. Beyond tomorrow, silver remains positioned at the intersection of multiple favorable trends. Industrial demand continues to grow alongside renewable energy adoption and technological expansion. At the same time, demographic and structural forces constrain labor market growth. This combination creates an environment where silver can benefit from both growth and uncertainty. The only scenario that significantly undermines silver is one where strong employment, high inflation, and elevated interest rates persist simultaneously. Current data suggests that outcome is unlikely. Efficiency gains reduce hiring pressure, while inflation remains sensitive to demand fluctuations. This limits the Federal Reserve's ability to maintain tight policy indefinitely. Investors watching the $75 level today should be prepared for a rapid movement tomorrow. Support and resistance may shift quickly as new information enters the system. Risk management matters more than conviction in moments like this. Index rebalancing will soon fade as a dominant influence. Once it does, fundamental drivers will reassert themselves. Labor data, yield expectations, and currency movement will regain control over price direction. Silver's behavior tomorrow will offer critical insight into how markets are interpreting the path forward. This moment represents more than a routine data release. It is a test of whether the narrative of labor stagnation holds or breaks. The outcome will shape expectations for the first quarter of 2026 and beyond. As traders prepare for the release, attention should remain focused on yields rather than headlines alone. The bond market often tells the real story before prices fully adjust. Silver follows yields with remarkable consistency over time. When the Bureau of Labor Statistics releases its numbers tomorrow morning, markets will not hesitate. The reaction will be swift, decisive, and unforgiving. Silver will respond not to opinion but to implication. By midday, the direction of the trend may already be clear. Whether silver challenges $80 or defends $72 will depend entirely on how markets interpret the health of the labor force. Tomorrow morning is not just another economic update. It is a defining moment for silver's trajectory in early 2026.